Okay, good morning, everyone. Hello, welcome. Let's take our seats. So, good morning. Thank you so much for coming here. On behalf of the organizing committee, I would like to welcome you to the 2023 Impact Investing Conference at Yale SOM. So, we are excited to have gathered an exceptional group of speakers today that will share their insights with you. And I had the pleasure to meet these speakers over the last few months, and some of them over dinner yesterday, when we were basically discussing about impact investing and some other stuff. But anyway, when I asked them what I should definitely share with people, what everyone should go out and know about impact investing, we came up with 3 things. So the first thing that we want to emphasize today is that impact investing does not necessarily mean sacrificing financial returns for impact. In fact, the practice of investment is changing, and more than $23 trillion are globally invested in impact-driven purposes, recognizing the long-term potential of these efforts. The largest asset managers are establishing impact investment practices, and we have lately seen the CEO of BlackRock acknowledging in a letter to shareholders that to prosper over time, every company must not only deliver financial performance, but also show how to make positive contribution to society. The second thing we want to tell you today is that impact investing is not only about ESG. While ESG standards is an important component, impact investing is much broader than that. It's not just about risk mitigation or minimizing negative effects, but it's about actively seeking opportunities to create positive change to the world, and by doing so, be more profitable. This, as we will hear today, involves investing in companies, organizations, or funds that have a clear and measurable social or environmental mission, such as renewable energy, affordable housing, education, healthcare, and much more. Lastly, we want also to bring to you a more uncomfortable and more unspoken truth. Creating meaningful impact takes time, and not all the commitments made, for example, to reduce emissions by 2030 or to promote decarbonization can be accomplished overnight. Social entrepreneurs that you will hear here today will tell you about the significant challenges that they are facing when they are trying to bring their mission-driven companies in front of venture capital firms. And the road ahead for them is not an easy one. So despite the progress that has made in recent years, there is still a long way to go for us. So ultimately, the goal for today is not to present you necessarily with a success story, but is to inspire you to create a new narrative, your own narrative, about the value that we want businesses to bring and the vision for which we want our capital to work for. So before we start, please join me to thank this exceptional team that we have worked together of MBA and EMBA students over the past few months to bring all this together. I would like to thank Jasmine Peng, Nick Lyos, Kelsey Overby, and Elisa Quaron for their efforts. We would also like to thank Charlotte Parker from the Menk Fund, as well as the International Center for Finance, and specifically Isabella Duenas and Leanne Clark, for their valuable assistance in organizing this conference. Please join me for a round of applause. And I would like to welcome to the stage our first speaker for today, Alix Peterson Zwane. Alix is the CEO of the Global Innovation Fund, a hybrid investment vehicle that accelerates evidence-based innovation through early-stage debt and equity investing, as well as grant-making. Previously, she served as an executive director of Evidence Action, a non-profit that develops service delivery models to scale evidence-based programs. Alix has advocated for evidence-based philanthropy at the Bill and Melinda Gates Foundation and Google, was a member of the faculty of the Agricultural and Research Economics Department at Berkeley, and has published in Science, Proceedings of the National Academy of Science, the Quarterly Journal of Economics, and elsewhere. She holds a PhD in Public Policy from Harvard University, is a World Economic Forum Young Global Leader, and a non-resident fellow of the Center for Global Development. Alix, we are happy to have you here.
Good morning, everybody. It is so nice to be here. Thank you so much for that nice introduction, and really congratulations on all of the hard work that's gone into getting this really dynamic group of people here together. I'm very excited for the day, and it's a real honor to be here with some of the future leaders in our growing field of impact investing. I know you're going to hear from lots of really inspiring and passionate people today, and I look forward to really thought-provoking conversations. I'm going to talk today a little bit about that intersection in the Venn diagram between accelerating innovation for social change and impact investing. I guess, and the place I think that we need to start with, and why is that interesting, is because we actually know less than we think we do. And I suppose that's true about a lot of things in all of our lives. But I specifically mean here in that case of, what sparks light the fire of inclusive green growth and social change. Those things that Femi was just talking about that take a long time to come to fruition. Sometimes we say in the policy space, or even just around the dinner table, of, oh, if only there were the political will to get such and such a thing done. As though it was just the case of some leader taking the reins to bring together financial and human capital to fund and scale up things that we know need to get done. But really, and this stuck with me once from a talk I heard Barack Obama give at USAID in sort of the last days of his administration. Really, hard things are hard. We don't always know what needs to be done, and it's simply a question of political will. We don't know how to make things less hard, and so change takes time. I see this little theme already developing here. And that's really where innovation comes in. We innovate and experiment not for its own sake, but to make hard things a little bit less hard. Make things politically easier, less costly, more profitable. And so let's take that sort of maintained hypothesis, hard things are hard, and bring that into thinking about, well, what's the state of the impact investing community as it thinks about driving for impact and that mission? And let me reflect on a few things again, as I said, at the intersection of that Venn diagram. So let's say that you agree with me that we need more innovation. We need more resources backing and funding innovation. We need to help entrepreneurs build markets that they sell into, not just scale up time-tested small and medium-sized enterprises. Look, and it would be wonderful if the tools of impact investing could drive change and learning. If we can generate understanding about social change and impact while also recycling capital, that could turbocharge the larger impact agenda. So let's explore that question. And let me try and make the case that I think we can put a few more tools in our toolbox to expand the size of that intersection of the Venn diagram. So let me start with an example. Oh, good, I see some of these pictures are already up here. Let me situate you in a world in which, this is in India, many low-income families are faced with the challenge that the quality of government schools is variable and lacking. Teacher absenteeism is a major issue, for example, and the curriculum is not necessarily well fit for purpose. In that context, a real lively business of affordable private schools has emerged, charging affordable, accessible fees intended to reach into the lower income strata of households. But this system is deeply fragmented, informal, quality is very variable. It is difficult for parents to assess that quality when they're trying to decide how to choose amongst these affordable private schools. So here we have an interesting opportunity. These businesses are making money. There's no question about that. This has the potential for impact, but currently as this works, that impact is not always realized. So there's a company called Chrysalis that has developed an age-appropriate, activity-based learning program that aims to provide measurable consistency and quality across these affordable private schools in a way that's understandable and accessible to parents. They have a flexible, play-based approach that seeks to improve the classroom learning environment, teacher and management capacity, and then ultimately, of course, learning outcomes. In 2020, the Global Innovation Fund made a $1.6 million equity investment to enable Chrysalis to expand its operations and product offering for these affordable private schools. This included digitization and teacher development and school training initiatives. Our funding came at a time of frankly real peril, right when the COVID-19 pandemic was freezing academic institutions. And it turned out to be vital for Chrysalis in thinking about how to expand a remote teaching offering and make their way through and navigate the complexities of the pandemic, and frankly, by extension, help GIF navigate our way through the pandemic and stay relevant during that time. In 2022, having made it through the pandemic, Chrysalis has helped educate every year about 250,000 students across 700 schools, about 1/2 to 2/3 of which are categorized as these affordable private schools. They assess their own impact by sending representatives into these schools regularly to assess learning outcomes and how teachers are doing. And right in their most recent report that they sent to GIF, they have estimated that they have a 12% improvement in student engagement in the affordable private schools, improvements in the overall quality and professionalism of teaching staff, increased teacher retention and satisfaction. We at GIF think our investment in Chrysalis counts as a good example of how you can find that overlap between innovation and impact. And we anticipate that this growing and increasingly profitable company will ultimately lead to exactly that success around financial returns in addition to social returns that we heard about in the opening remarks. So how can we crowd in more capital for innovations like Chrysalis? Well, let me step back now and talk a little bit about that at a sort of meta level. And begin by saying, how do we think about that at GIF or at the Global Innovation Fund? The Global Innovation Fund is kind of a unique entity in the international development financing landscape. We are a nonprofit, impact-first investment vehicle that was originally launched by the governments of the US and the UK to help solve challenges that they had about supporting venture-style investing in development. And GIF's mandate is to accelerate innovation, to solve hard challenges that face the world's poorest people. Innovations, exactly like Chrysalis, help us to do that. So how at GIF, how did we know that Chrysalis was the right innovation to invest in? Or how did we know that its approach would take off across schools in India? How did we know that we'd have impact here? Well, the truth is, of course, we can't know that with certainty. When we invested, we took real risks. And I know I'm talking to a room here of investors and taking on and measuring and thinking about whether you're willing to bear a particular risk. Like, that's your bread and butter, right? And if you're thinking purely from a financial perspective, the investment question can boil down to exploring whether and why you think your expected risk-adjusted rate of return exceeds your hurdle rate. The problem that we collectively have, though, as impact investors is more complicated than that. How do we think about this? I'll put to you that we collectively are not just in the profit maximizing business. For us, given an initial budget, we want to maximize impact. So you want to back impactful innovations or entrepreneurs, sure. But you want to back innovations that scale. Scale is necessary for meaningful impact. And that means you want to back innovations that can figure out their business model, make money, and grow. And of course, yes, we all want to eventually exit so that you can recycle your capital and generate more impact. And the way I told that story there, well, maybe that doesn't sound so different from a traditional venture capital approach to investing. Make investment decisions based on rigorous evidence. Adopt a staged approach to funding. Take smart risks. And pool risks across your portfolio. The difference really is the starting point. For us, that means impact first and financial returns as a means to that end. It is a more complicated problem to solve. It might require data not available in financial models because you need to evaluate for impact. It might require more patience than we typically would have with traditional closed-end funds. And yes, there really might be trade-offs between impact and scale, or at the very least, the pace of scale. Hard things are hard. And so as an honest impact investor, we really need to be humble. We need to be humble about our limits of our understanding about what's going to work and what's not going to work. And we need to be willing to test out and experiment, ourselves so that we can discover along the way other things that we might have never actually considered. This is what the Nobel Prize-winning economist Michael Kramer has referred to as the virtuous cycle of evaluation and innovation. The idea that experimental results can uncover hidden factors and suggest new directions for intervention, innovation, and evaluation. And with patience, this can continue to unfold and unfold. So why isn't there more impact-first capital flowing to international development? Why did the governments of the US and the UK think that they need to put aside taxpayer dollars to accelerate innovations like Chrysalis? Well, some of this has to do with the current approach to development finance, and it's not entirely fit for purpose for the needs of companies and entrepreneurs today. And I think that this has some interesting opportunities for the folks in this room to think about. First of all, we need to think about different kinds of investment vehicles and how we're actually pricing risk. Traditionally, in development, wealthy countries have had two tools at their disposal to fund international development. Aid agencies that fund through fees for service contracts, potentially giving a contract to the Chrysalises of the world, and then development finance institutions, or DFIs, that make private equity-like investments. And both of those things are valuable and useful. And they may crowd in private capital, but their approaches to financing leave a real gap for innovators. DFIs in particular, the development finance institutions, have been reticent to take on the risk associated with early-stage innovative ventures. They're looking for a more tested deal flow with more certain rates of return. And so that creates a pioneer gap in which companies like Chrysalis can fall. Entrepreneurs trying to build the markets that they're selling into often struggle to attract the kind of capital that they need. There's neither a deep pool of venture capital willing to take risks on firms that are building markets, nor are the DFIs with a development mandate able and willing to tolerate risk. That pioneer gap can easily become a chasm. So how can we think about what kind of tools could really help out in this kind of situation? Well, Nancy Lee at the Center for Global Development has suggested something called a stretch fund, a pooled investment fund that would work together with traditional multilateral development banks and development finance institutions to address existing market shortcomings. It would stretch the capital of existing DFIs by expanding the spectrum of investments in which they can participate. The stretch fund would have a unique mandate of taking on higher risk tranches at concessional rates of return, and then lets risk-tolerant DFI funds could participate in a more senior position. As Nancy says, less lending, more mobilizing would be the mandate of the stretch fund. Now, there's no reason that the impact investing community couldn't come together to create such a vehicle, perhaps specifically for climate investing, for example, or that specific funds couldn't take on this more mobilizing USP as their mandate. If this community could develop a successful track record with this approach, it could add to the case for a global stretch fund backed by the DFIs or MDBs at a much bigger size. Now, it's not just a question of the right kind of investment vehicle. It's also the question of pricing risk correctly. And that's the last topic I want to give you a little example of. Another innovation in GIF's portfolio is Mr. Green Africa. This is a tech-enabled plastic recycling company trying to disrupt the current informal pricing plastic recycling sector in Nairobi in Kenya. The business is trying to create an ethical supply chain in recycling. So they purchase directly from waste pickers and are committed to wage premiums, uniforms, training, and dignified jobs that they can then sell their recycled material at a premium to multinationals like Unilever, for example. When we came into contact with Mr. Green, this was in 2019, they were trying to raise their first equity round and really struggling with investors' perceptions of risk associated with their business. And, this can be quite commonplace, particularly for international investors thinking about investing in African companies. There is a real information asymmetry. Emerging markets can lack some of the tools that investors are used to for assessing risk, but there's also just a perception that can come from an aversion to the unknown. A lack of understanding of market conditions and regulatory regimes is misclassified as objective measurable risk. And then, of course, distinct from real or less real political and regulatory risk, ESG concerns can be very real and legitimate. Certainly, you can imagine with Mr. Green Africa that there's concerns about petty corruption. And could Mr. Green Africa really confidently address challenges like child labor? Traditional waste picking and recycling is notorious for both of those issues. I mean, that's what motivated them to open their business. So here they are, struggling to attract capital. And GIF made the choice that we were going to enter into this investment very much with our eyes open, that we were going to think about the trade-offs between potential impact, examples of dignified jobs that could be replicated in many other contexts, and the potential for mitigating methane emissions from landfills. We were going to figure out how to bear that ESG risk in pursuit of this social impact. So we worked very closely with the company in the initial years when we were invested in them on an ESG risk mitigation plan. So we helped to fill gaps in their audit function, set up an external whistleblowing hotline, helped them to implement health and safety measures. When challenges arose, which they did, we didn't back away, but held the firm accountable as a partner in addressing them. And last year, Mr. Green raised their Series B round, and GIF, we didn't participate. We played our part in de-risking the company, and now we were able to step back and watch capital be crowded in and not crowded out ourselves. I think it's a very good example of both acting sort of as a stretch fund, less lending or less investing in this case, more mobilizing, and figuring out how to tolerate and bear ESG risk to help a company build its market as they sell into it. So let me close with just sort of summarizing what I hope are some of the takeaways from this. For those of you here today who are looking to pursue a career in impact investing in international development, I challenge you to take on the hard things in our field. Maybe I'm looking at the founder of the first stretch fund right here in this room. To innovate, we need to be humble. We need to be comfortable with the idea that we don't have all the answers about what works, and be open to evaluating and learning in that virtuous cycle. We need to be creative about the structures we build, not just what we invest in, so that we can invest in high risk and more fragile places. We need to be comfortable building if we don't see what we need out there. And this approach can lead to real benefits and real impact. At GIF, we've invested about $100 million since I've been the CEO. In our last impact report that we released 2 weeks ago, we were able to say we think we've contributed to $1.7 billion in social value. So innovation can pay. Yeah, hard things are hard, but when you make some progress against them, it can really pay off. So let's take some smart risks to do some hard things, and I look forward to learning from all of you as the rest of the day goes on. Thank you very much.